One of the things that makes One Rental at a Time unique is we bring on millionaires from all different experiences and skill sets, and we have receipts. We have playlists from all these wonderful individuals. And if you go back and look at Anna's playlist, you will see that for the last year, we have been warning LPs about some syndication, some behavior that we frankly did not like, frankly, that we thought would lead to losses. We have both said that there are some LPs that have lost all their money and don't know it yet. Why is this important? Well, obviously, the commercial banking sector is under attack. It is in crisis. It is now coming out that a lot of these, I don't know, toxic loan products are, held to maturity, are not worth what they are on the balance sheets. Why is this important? It's because regional banks play a significant part of the commercial lending market. In fact, we saw Signature Bank, one of the two banks that closed a couple of weekends ago in New York, recently get sold. I don't know if you saw this, Anna. Recently got sold to a consortium for New York Bancorp. Unfortunately, it wasn't sold lock, stock, and barrel. What was left behind was $60 billion in multifamily loans attached to affordable housing. This is New
Oh, I
York
didn't see
affordable.
that part.
Yeah, New York affordable housing, rent controlled. So basically what is happening in these loans is income can't go up. Expenses are going up. Cap rates are going up. So these loans are not worth what they are at. These are problem properties. They will have haircuts, probably significant. Why I bring this up is there's a lot of multifamily, a lot of office, a lot of retail. The commercial lending market got over its skis, bad assumptions, short-term debt, and there's going to be some pain. So you and I warn people, but I'm here to say that I think it's going to be bigger and more painful than I originally thought. Where are you at in all of this?
Yes, very good points. And we have talked about a lot of these things, potentially happening depending on how high the Fed hikes rates and how long that lasts. And the reason is, and a lot of people don't really understand this, just to kind of simplify things for people, is that values of commercial real estate very much go up and down with interest rates, with long-term interest rates. And so with really low treasury rates, which is considered this risk-free rate of return before everything happened with these banks, right? You can bank on the full faith and credit of the United States. If you can get a safe return with no pain, completely passive, no tenants that could move out, maybe not pay, damage your property, no things going wrong, you would buy a treasury. But people want higher returns, and so they take on a little more risk. And so commercial real estate has essentially been considered about as risky and profitable as triple B bonds, like a little bit more risk and a little bit more upside than triple A bonds, high quality corporate bonds. But then you start to, create a little more return, but you got to take some risk for that. And generally speaking, when rates are held really, really low, it creates a frenzy to go try to borrow low and create spread and create value. That's why you have asset bubbles, right? In the stock market and commercial real estate, in anything that basically is competing with treasury rates to create yield. And so commercial real estate has been really stable for a decade because rates have been very, very low. And so cap rates have come down because there's been so much competition that people are willing to make a less of a return to get a quality asset when there's uncertainty and other things like inflation. And so what you had post-COVID was really cheap debt and then lots of easy money, easy loans, bridge debts, allowing you to overpay for properties as they are today with short-term debt, interest-only loans, create an increase in the value with the hopes that you then sell at higher values or you refinance at a locked-in low rate. Well, suddenly the rates are so much higher than what everybody anticipated when they got in these short-term loans that suddenly they can't refinance the properties at the rates that they estimated or sell at the values that they estimated. And to be a double whammy, interest rates are going up, which also means that now the risk-free rate of return is 5 on properties that we're selling at a 3.5 and 4 cap. So cap rates have to go up above the treasury to maintain that risk premium. Hey, if I'm taking risk, I want a better return than I did. And that's making cap rates go up, values fall at the same time that you can't refi out at a lower rate. And so you basically have a lower value, so you can't sell as high as you thought, and you can't refinance because rates are high, values are low. And oh, by the way, when we get into these kind of crazy markets, banks get nervous and they tighten up their requirements. So they give you a lower loan to value than what you anticipated a few years ago today. And that's really why there is so much pain through all asset classes in commercial real estate, not just the ones that are even riskier, like you talked about New York City, where there's rent controls. You can't raise your rent to catch up with the expenses, and therefore you can't raise the value. You can't sell them, you can't refinance them. You're in real trouble. Add office
Yeah.
and retail to that, and they're in significantly more trouble than multifamily as well.
Yeah, there's a lot of pain. And again, if we really look at it, and these numbers are right, they've been widely reported. So I'm just quoting what I heard. 50% of commercial loans are originated by regional banks. I don't think it's
It's more than
unheard.
that.
Yeah, I don't think it's unheard of to say that they're in some real trouble. But what does real trouble mean? This is what I think it means. First, it means they're going to significantly constrain net new loans. Why?
Yes.
Because they need to work on what they've already eaten. They need to take what's on their balance sheet, figure out who's who in the zoo, sell some off, rewrite some, extend and pretend. They have quarters, if not a year of work ahead of them, taking care of the stuff. And the last thing they want to do is add more net new on top of it. So net new originations going way, way down. And oh,
Yes,
by the
and
way,
that's
loan
happening
workouts.
now. So I'm in
Of
this
course it
space,
is.
right? I'm in the multifamily space. I'm still actively looking at deals, understanding what the risks are, right? And finding those deals that de-risk those things happening. But I'm in real-time conversations on deals that we're looking at with lenders. And I can tell you that lenders' money is definitely squeezing and tightening up to where unless you're a really experienced operator and really well capitalized, have a strong net worth, strong liquidity, years and years of experience, you're going to be lucky to get a yes answer at all on commercial real estate right now. But loans are still there. For
Sure.
multifamily, if it's a good deal and you're not overpaying, you'll get a loan, but you're going to have to raise or put in significantly more money. They're
Yeah,
capping out at about 60% LTV, Michael, where before all
exactly.
this started happening, we could easily get 75, 80% LTV. So really great quality assets will continue to get financing, but banks are having a flight to quality, just like investors are trying to flee to quality. And so you're going to have to be really, really good. And if you're a passive investor, you've got to be investing with teams that really have the experience and the wherewithal to play in a riskier environment than what we had a couple years
Yeah.
ago, for sure.
Yeah. So again, new loan origination, I think they call it, volume is going to go down. They're going to work on
Yes.
what they have. There will be deals and opportunities. We'll talk about that in segment 3,
Yes.
what we're excited about. Um, but yeah, it's going to be a year. And there was something done by Apollo Group, somebody I forwarded on Twitter, follow me one rental at a time. They actually said that what's going on in the regional and the banking sector was equivalent to a 1.5% rise in the Fed funds rate. Tighter criteria, more equity into a deal. It's basically doing the job of the Fed to the tune of 1.5%. And if that goes up, that means the cap rate has to go up even more. So we're going to have this real battle between buyers and sellers if we were active today, because they're not going to see eye to eye given the cost of capital and equity requirements have drastically changed in 60 days.
Right, definitely for sure. And what I will say too, because again, I study this because it's my bread and butter. It's what I do every day, right? I've gone back and looked at, as long as they've been tracking cap rates back in the 1980s, they started tracking back to about the 1960s. Unfortunately, we don't have great data before then because cap rates were just calculated very, very differently.
Yeah.
But essentially, when you have uncertainty, there's a flight to quality, right? The banks want quality assets. You as an investor want quality assets. And so if you're buying multifamily, for example, in really strong, resilient markets like Raleigh, North Carolina, Dallas, Texas, where GDP is stronger than national GDP, where you have a lot of diverse job opportunities, high paying jobs, low cost of living, really great schools, really low crime, and conservative local politicians who are landlord friendly, and aren't really jacking up your taxes. Those are the kind of assets that create stability, and banks want those assets. You as an investor, whether you're active or passive, you want to be in a quality asset in quality markets, and you're going to have a significantly better experience getting loans, raising rents, having your properties bounce back more quickly, and the cap rates actually not rising as quickly. And what I have found historically, Michael, is that Class A markets, whether your asset is brand new or even a Class B quality market, the cap rates actually start to fall when there's crazy volatility or threat of crisis in Class A, because people leave the stock market, because usually it means there's other things happening in the economy, and they fly to multifamily. The head of Fidelity just said multifamily is a great place to be right now, just this last week. And it's because it's a flight to quality. But not all multifamily is the same, just like not all single family or vacation rentals are the same as well. So flight to quality, invest in quality markets and quality newer assets. You're going to do a lot better. And you're not going to have to worry about the fact that cap rates are rising in general. You hold assets for a little bit longer term, and you'll do just fine. So with the fear that we're creating, I also just want to give, some balance to show there's always opportunity. And if values are falling, it's a great time to pick up those assets, hold them, because they're the ones that recover most quickly, is really great quality commercial assets in really, really strong markets. If you play, in that space, you're going to do just fine over time.
There you go. And folks, we will actually make that the topic of video number 3. Where do we see the opportunity? Is this perhaps the biggest opportunity of our investing lifetime? What might it mean for you, the individual who maybe doesn't have anything yet? But before we do, Anna, where can people find you?
Great. You can find me here every week and on my playlist on your channel, on social media at Anna Kelly, REI Mom. If you're an accredited investor looking for quality passive investments, you can find me at greaterpurposecapital.com.
Thank you so much.